So, evening, and welcome to my session on business tax and specifically adjusting trading profit. So, business tax, one of the currently optional units on level 4, to be replaced in September on the new level 4 PAT with this thing called principles of taxation, which is a mix of personal tax and business tax, which very similar content, but you're going to put them into one unit. So, what I'm talking about tonight then, adjusted trading profit, is covered in task 1 of the business tax exam. So we're going to cover a few different things in the next hour that hopefully you'll find useful when you're looking at task 1 on business tax. So let's make a start. So just split it up into a few different sections. So we'll start with all the fundamental stuff, and then we'll move into some of the more detail as we go through. So overall objectives that we've got really for tonight, and if I can achieve all of this, then we've done really well. Learn how to, so split it into 3 really. Called the first bit the bridge, but ultimately learn how to convert accounting profit to taxable trading profits and be able to do that accurately. Identify the rules, so identify all the common disallowable expenditure, non-trading income categories that we need to be aware of when we're looking at the difference between accounting profit and taxable trading profit. And then we've got this exam to do, or you've got this exam to do at some point. So we want to hopefully master the task 1 pro forma for both companies and unincorporated traders, which is mostly going to be for companies, isn't it? It's limited companies at level 4, but the theory spreads across, unincorporated businesses just the same as it does incorporated businesses. So the very starting point of all this is we have a set of accounting statements. So typically our statement of profit and loss, and on that we've got some level of accounting profit or an accounting loss in some cases. And now that's determined, isn't it, by this thing called GAAP, generally accepted accounting practice, or IFRS, International Finance Reporting Standards. Set of rules that we follow, so we can choose, you might know that we can choose from what's known as UK GAAP, generally accepted accounting practice, or certainly for PLCs, but limited companies have a choice, International Finance Reporting Standards. So if you're a listed company, you must use IFRS. If you're a non-listed company, you can choose either or, so IFRS or UK GAAP. UK GAAP, typically FRS 102 in the UK, which is the UK standard set by the Financial Reporting Council. So accounting profit, as we hopefully know, includes all business expenses, things like depreciation, customer entertaining, all of the various expenses, and it shows the true performance of the business. So there's revenue, cost of sales, gross profit, all other costs, accounting profit. Yeah. So that's one element. We also need this thing called adjusted profit, or what's sometimes called as total taxable profit. So adjusted profit is determined by tax law, and it adjusts for all the items that are not wholly and exclusively for trading purposes or that are specifically disallowed. So at this point, what we just need to understand, there is a difference. Accounting profit, yeah, that's great. That's what's on the bottom of the statement of profit or loss. That's, the true measure of performance in many ways, but that's not necessarily what we pay tax on. So greatest example of that is someone like Starbucks. Everyone's seen Starbucks. Starbucks sell a lot of coffee, make a lot of accounting profit, ultimately. However, they don't make too much taxable profit because they have a load of things that are disallowable. They have a load of extra adjustments, and what they pay tax on is very different to the true accounting profit. So when you look at task 1 on the exam, it will start with net profit before tax, or sometimes known as operating profit before tax, or sometimes PBIT, profit before interest and tax, as shown in a set of accounts or set of financial statements. So that'll be the starting point, and then go from that to taxable profit. So the key principle, or the statutory principle, so the legal position here, is that expenditure is only allowable for tax purposes if it's been incurred wholly and exclusively for the purpose of trade. So that's from the Income Tax, Trading and Other Income Act of 2005. So that's the statutory piece of legislation that says expenditure is only allowable for tax purposes if it's wholly and exclusively for the purpose of trade. If it's not, then it very clearly is not allowable. So just as a starting point of then what the pro forma looks like. So I mentioned we've got net profit, PBIT, operating profit. So that's the top line on this pro forma. So net profit as per the accounting records. So as per your financial statements, that's just, yeah. And then we're going to add back in any disallowable expenditure, because anything that's disallowable, we need to pay tax on. So at the moment, we've taken it out. It's not in the net profit in the accounts, but it's disallowable, so it needs adding back in, because we're going to have to pay tax on it. We're going to take out any non-trading income. So any income from non-trading, and take that out, decrease profit, we're not paying tax on that. We're also going to make an allowance for our capital allowances. Yeah. So it's going to decrease profit on which we pay tax due to the fact that we're going to claim for capital allowances. And the bottom line, taxable trading profit, that's the final result. That's the thing we're ultimately going to pay tax on. Yeah. So what are some of the areas of disallowable expenditure? So I touched on it a little bit, but we'll touch on it a little bit more. So we need to be very aware of the difference between capital expenditure and revenue expenditure. Yeah. So revenue expenditure is allowable. So repairs that restore an asset, redecoration, routine maintenance, all revenue expenditure. Yeah, that's very much allowable for tax purposes. Capital expenditure is disallowable. So it's not disallowable from an accounting profit perspective, but it is disallowable from a taxation perspective. So improvements, extensions, repairs to newly acquired, dilapidated assets to make them usable is all capital expenditure, all disallowable from a taxation perspective. Depreciation is always added back in. Yeah, so it's come out in the calculation of accounting profit, but it's always added back in when we calculate total taxable profit, because then we get relief through capital allowances. Yeah. So from a tax perspective, we add the depreciation back in, then we relieve the effects of the depreciation through capital allowances. Yeah. So it's very important that we understand there is a difference between ultimately accounting rules, so rules around accounting profit, and rules around taxation and taxable profit. There's different sets of rules, which is why this is not in the drafting and interpreting financial statements unit, and why that stuff's not in this unit. They're two different concepts. Whilst connected, they are different. Other things that are disallowable then are legal or some legal and professional fees. So things that are allowable, just a few examples. So any legal and professional fees related to debt collection. So if you employ a debt collection agency to go and collect some debt from one of your trade receivables, and obviously they'll charge you for that privilege, then that is an allowable cost for taxation. Staff contracts. So if you employ a solicitor or a lawyer or some legal firm to draft some contracts for staff, so it could be a change of employment contract or a transfer, a TOOP agreement of some sort, then that's allowable. Renewal of any short leases. So if you were leasing a building from a landlord for 20 years, as long as it's less than 50 years, the cost related to that is allowable for taxation. What is not allowable is any legal or professional fees relating to the purchase of a capital asset. So if I am purchasing a warehouse, for example, capital asset that I'm likely to use for a considerable period of time, the legal and professional fees relating to that are not allowable. Settling of any tax disputes. So if I don't know, we're in some dispute with HMRC about the underpayment of some form of taxation, and we employ a legal company to defend us in that case, then that's not allowable. It's allowable for accounting profit perspective, but not allowable against our tax bill. And the same is true of long leases. So any costs related to long leases, so leases over 50 years. One thing that is specifically allowable, however, is professional fees for the defending of a patent registration. So if you apply for a patent and somebody objects, then the professional fees in relation to defending your position are specifically allowable. That's not disallowable expenditure, that's very much allowable. Now, some of this, generally when I teach this, some of this stuff on this slide confuses students massively. So there's three concepts on here: fines, penalties, and fraud. So fines that are placed on the business. So fines on the business for things like breaches of health and safety, late VAT payments, late PAYE payments, any fines and indeed penalties relating to breaches of health and safety, VAT, being late, any other taxation being paid late or it paid incorrectly, or disallowable from taxation perspective. So you're going to have to pay. It's disallowable against corporation tax bill. Employee fines. Now this is where people get really confused, because they think, well, if it's a fine on the business, so if the business gets fined for breach of health and safety, that's disallowable. But if one of your employees goes and parks on some double yellow lines and gets a parking ticket, suddenly that's allowable. So parking fines incurred by employees on company business are typically allowable. The only real exception to that is if that employee is a director of the business, in which case it's not allowable. But generally, if you went and got a parking ticket, whilst on company business, then hopefully your company will pay for it. Your company will claim that against accounting profit, but it's also get relief against corporation tax. Now, fraud's a massively interesting area. Again, people think that any level of fraud, it would be disallowable against corporation tax. Not necessarily true. Director fraud, very much disallowable, and very much, if we knew about it, we're probably taking some further action. So that is definitely disallowable. However, things like petty theft by a non-senior member of staff. Now, the problem there is to define what non-senior is. My experience, generally, someone who doesn't hold a senior management position in the business or is not a director. So petty theft by someone like that is allowable. So, for example, if somebody, I don't know, there was some petty theft of photocopier paper or pens, paper, notebooks, yeah, marker pens, all the things that if they're not nailed down, people generally take, yeah. Any theft relating to that or loss of inventory on a petty level, so not material, is allowable. Obviously, large material theft is a different thing. You'd probably investigate that, wouldn't you, and do something about it different. Make some provision for loss and all that sort of thing. Another big interesting area for taxation, as we know from when we did level 3 tax processes, is the whole area of entertaining and gifts. So first thing we need to understand is the split between staff and customers. Yeah, staff for taxation purposes, wholly allowable for taxation. So company's annual party, for example, wholly allowable against corporation tax. Obviously, different rules for VAT, which we're not going to get into this evening. But from a accounting profit perspective, anything you spend on staff entertaining would be deductible from calculation of accounting profit. It's also allowable deduction against corporation tax. Customer entertaining is 100% disallowable. Yeah, when it comes to taxation, so it's allowable against accounting profit. Some of that is allowable against VAT, should you be VAT registered, but it's 100% disallowable against taxation, and that includes both UK and overseas customers. Gifts, so gifts to employees, yeah, so employee gifts are allowable, yeah, but customer gifts have some fairly strict rules, yeah. So any gifts you make to employees, they're allowable for corporation tax, but customer gifts in most cases aren't, but there are some cases where they are, which we'll have a quick look at. So from customers' gift perspective, there's the £50 rule. So it's £50 limit paid only per year, and a bunch of mandatory conditions. So it must carry a conspicuous advertisement for the business. So I can't just, so let's say I were giving out, I don't know, let's say we're giving out thermos flasks to all our customers. We can't just go and buy a thermos flask off the counter in Tesco's and give it to all our customers. Although we could, it's not allowable here for taxation purposes because it does not carry an advertisement for our business. It's got our business's logo on it. Yeah, now we can get corporation tax deduction for that. Cannot be food, drink, tobacco, or vouchers. Now, this confuses quite a lot of people because a lot of people think, well, so if I give something worth £40 and it's, I don't know, a bottle of whiskey that costs £40, is that allowable or not? No, it doesn't matter that it's less than £50. Yeah, it's alcohol. It's not allowed. Food and drink, tobacco, vouchers, not allowed for taxation purposes. That does not mean you cannot give that to someone. So it doesn't mean, for example, that businesses can't give customers something that costs more than £50, something that doesn't have an advertisement on it, and is a bottle of really expensive whiskey. You can do that. What we're saying here is that would come out of accounting profit, but is disallowable for corporation tax. And then the final thing that really confuses some people is if the cost exceeds £50, the entire amount is added back as disallowable, not just a bit above £50. So if I buy a customer a polo shirt, for example, that costs £60, has my logo right across it, and I give them that and only that, then cost exceeds £50. So the whole £60 of that t-shirt, that polo shirt, needs adding back in, not just the £10 that's above the 50. So the whole thing gets added back. Yeah. So the general rule, stay below £50, because otherwise the whole thing's disallowable. So irrecoverable debt. So what do we do with irrecoverable debt in terms of being allowable or disallowable against taxable trading profit? So trade debts, so bad debts from trade. Yeah, so the writing off of any trade debt, so that's writing off receivables balance, is allowable. And it also includes movements in specific provisions, which is mandatory for any companies using IFRS. Yeah. So what we're saying there is very specific provisions and specific debt. Yeah. So writing off a particular customer, making specific provisions. Yeah, for doubtful debt or irrecoverable debt. From a non-trade perspective then, so if you've got any debts that are related to non-trading, so writing off loans to former employees, that's not from trading. So you've lent them some money, but they've left your employment, not paid it back. It's a level of irrecoverable debt, but it's not from trading. Yeah, that's sadly disallowable, as are movements in general provisions. Now, general provisions are not generally seen in incorporated businesses. Most incorporated businesses make specific provisions, but general provisions are seen in unincorporated businesses. Specific provisions are mandatory under IFRS, so certainly PLCs need to make specific provisions, not general ones. So yeah, general provisions are non-trade, irrecoverable or bad debt, disallowable for calculation of corporation tax. Next thing then that you will find in task 1 is car leasing. So car leasing, for anyone who doesn't understand the concept, so instead of buying the car or taking some sort of hire purchase on the car, you physically lease the car. So you've got right of use over the asset in exchange for a monthly fee, usually, for leasing it. So it follows a set of rules for any cars with emissions exceeding 50 grams per kilometre. Part of the car leasing cost is disallowable. So 15% of the hire charge or the lease cost is added back. Yeah. Now this only applies if you're using accruals rules for accounting, which obviously companies will be doing. Vast majority of the limited companies definitely be operating their accounts under either UK GAAP or IFRS and using accruals basis of accounting. Unincorporated businesses, remember the default for unincorporated businesses in the UK, so sole traders, the default is cash basis. You can elect to use accruals basis if you're an unincorporated business. So if you are a company or an unincorporated business that's using accruals method, this is what applies: 15% of the hire charge if the vehicle exceeds 50 grams of CO2 per kilometre, is the 15% of the cost is added back, so 15% is disallowable. That does not apply if you're using cash basis, which we'll look at in a minute. So if you're using cash basis, so ultimately you're sole trader, unincorporated, potentially you're not affected by those rules. Right, section 3 then, just some specifics about proprietors and owners of businesses, and just some specifics around what might be allowable and disallowable in terms of business owners. So private use adjustment. So this is one thing that I actually love to put in the question. So there's some level of private use of something. So first thing we got is this slide's about unincorporated businesses. So any business that's unincorporated, so sole trader. Remember, the sole trader is not a separate legal entity, and therefore salaries and drawings are always added back because, well, there's no legal distinction, so they're added back. Private use is always added back, so the private element of both motor, phone, home cost are added back. And the proprietor's national insurance or any personal taxation paid through the business accounts are added back because, well, they're not the business's expense, are they? They're their personal individual's expense. Remember, from an accounting perspective, they're not legally, they're legally the same entity, but from an accounting perspective, they are separate entities. So we want them to be separate when we're calculating taxation. What about goods you use for your own use? Yeah, so if we're using accruals basis in our accounting system, then the owner of the business or the proprietor of the business must be taxed on the full selling price. Yeah, so not cost. Yeah. Now, the cost, you might only have recorded the cost. And if you have, you need to add back the profit item, profit element. So you might have already accounted for the cost, yeah, as part of your accounting profit calculation. Yeah. But from a tax perspective, you need to also add back in what the level of profit is. Yeah. So you need to be taxed based on the full selling price or full market selling price. Cash basis is quite simple. So cash basis of accounting, really simple. Only the cost needs to be removed from trading profit. Yeah. The profit element is no profit element's taxed because you haven't sold it yet, have you? Yeah. All you're going to do is take out the cost, remove the cost from the trading profit. Now, the big exam tip there is to check in the wording of the question if cost of sales has already been reduced by the cost of the goods for your own use. If it has, then obviously you only need to add back in the profit element. Yeah. If not, you need to add in the cost and the profit element. So it's just really important just to read the question to understand which bit, if any of it, has already been accounted for. Right, section 4 then, looking at income adjustments. So we need to, when we're looking at trading profit, so adjusted trading profit, there's the trading element which we've looked at, but then there's potentially in your accounting profit a bunch of things that are not from trading. Yeah, so from an accounting perspective, you might be reporting a certain level of profit. And then when we come to looking at corporation tax, we only want to pay tax on trading items, not all this potential non-trading stuff that is filtering its way through in your accounting records. So property income. So property income or rent received is taxed as property income. not trading profit. Yeah. Now, real world example I've seen before where companies do multiple things, and part of what they do is they might rent out some property. And from an accounting perspective, they just account that as another line on the profit and loss account that says property income. And then from at the bottom, the company's accounting profit is whatever it is. Well, that's great, but what we're saying here is actually we need to deduct the property income out of the corporation tax return, because the corporation tax return is on trading profit. So rents received taxed as property income, not taxed as trading profit. Still going to pay tax on it, but just in a different part of the computation. Investment income, so bank interest, dividends received, they're taxed separately. So they're not taxed as trading income, they're taxed on a separate line. So for now, we're going to deduct investment income. And then capital gains. So the capital gains, profit on the sale of non-current assets, and you can make a capital gain or capital loss from that. Assuming we make a capital gain, we're going to deduct the capital gain from trading profit. So a couple of key differences between companies and unincorporated businesses. So proprietor's salary, so the owner of the business's salary. So from a company perspective, it'd be a director's salary, that's allowable. And from a unincorporated business's perspective, that's drawings. Drawings are disallowable. Private use company, yeah, from a company, private use, no adjustment, be taxed as a benefit. From an unincorporated business, you're going to add back the element of private use. So, got, I don't know, £10,000 laptop, bad example, £10,000, well, £5,000 laptop, yeah, top end MacBook, £5,000 laptop, and you're using it 50% for private use, 50% for company use, and you're an unincorporated business, you need to add back in the private element. If you're a company, no adjustment, but you're going to be taxed benefit in kind on the value of the laptop. Donations, add back the donations if you're a company, so they are known as qualifying charitable donations, and they're deducted later in the calculation. So you add them back in at this point and deduct them later. If you're unincorporated, then local charity donations are allowable. So to local charities, allowable. National charities are disallowable. Yeah, I don't make the rules. And define local and national becomes a bit grey at times. Charitable relief then, so if you're, giving to charity and wanting relief against taxation, you get a deduction against total profits if you're a company. So very much a deduction from the corporation tax we pay. If you are unincorporated, it's generally done through gift aid relief on you personally as the owner of a sole trader business. So just big gift aid relief, which is a slightly different scheme, which I'm not going to go into right now, but it's a slightly different way of doing things. I mentioned cash basis. Now, cash basis is the default basis for unincorporated businesses. It has been since the 24-25 tax year, which makes things interesting at times. So for unincorporated businesses, income and expenses are recognised when they are physically paid and received, which is everything that we have not learned about accounting. So we've learned all about accruals, method of accounting, and how income's recognised when it's when it's earned, not when it's paid, and expenses when they are incurred, not when, again, the expenses are actually paid. The default for sole traders, the absolute default since the 24-25 tax year, is that it's cash basis. You can opt to do it under accruals basis, and lots of sole traders do that. Not to say lots of traders don't do cash. Lots of traders do cash. The reason, the argument for cash basis for sole traders is that it's just simpler for them to be able to, get their head around. But arguably, any accountants preparing sole trader accounts will be doing it using accruals method, and having things like prepayments and accruals and all the other benefits of the accruals method of accounting. As it says there, key characteristics of cash basis: no year-end accruals or prepayments, no bad debt provision. But what do we do in terms of capital allowances and capital treatment of assets? So plant and machinery costs are 100% allowable as a revenue expense when paid. So that's almost go and spend £100,000 on a piece of plant and machinery and have it all back now. So 100% allowable at that point. Well, obviously you're not getting 100% of the value back, but 100% deduction against taxation. Except for cars, land and buildings. Normal capital allowances apply only to cars. And there's no 15% car lease deduction, is there? So we say that if you're using a accruals basis, 15% of the lease cost is disallowable. That's not the case if you're using cash basis, mainly because, well, you're using a totally different scheme, aren't you? Totally different way. So the methodical approach to task one, the way I think you should probably approach it. So from a starting point, identify what the net profit is from the accounts. And ensure that number is pre-tax. So sometimes I've seen or heard that, you might get a number that's after tax, and then somewhere in all the gubbins with the question, it might say, well, this is the post-tax number in the accounts, and tax was some amount of money. So you can just add that back to get the pre-tax amount. So ultimately you want this pre-tax profit, so net profit or operating profit or profit before interest and tax. You're then going to do all your add backs. So I would start by adding back depreciation, any entertaining cost, any capital items, any private use. Then look at the things you need to take out. So your deductions. So rental income, interest, profit on assets, so capital gains, and deduct your capital allowances. So do your capital allowance computation, work out what the level of capital allowances that you can claim are. And then the very final thing, and lots of people don't necessarily do this, in the pro forma you get, make sure, unless the question tells you not to, enter 0 for all allowable items that require no adjustment. I've definitely seen people lose marks in the past where they've not put zeros. The question will say, please enter 0 in every box, essentially, and people don't, and then they start losing marks because they've not, everything is arithmetically correct, but they've not put the zeros in the places where they should have put zeros, and then they lose marks as a result of doing that. And then just check the numbers, make sure the numbers all make sense. So I had a few questions for you all. Feel free to whack them in the chat if you want. So scenario 1 then. So company pays £200 for staff pizza party, allowable or disallowable? I'll give you a few minutes to type. Yeah, so company pays £200 for staff, pizza party, yeah, it's allowable. Yes, it's for staff, it's not for customers. We're not talking about VAT or anything like that. So yeah, the whole lot, doesn't matter how much it is allowable for taxation purposes. Right, scenario B then. Sole trader takes stock which cost £100 with a sales value of 150, and no entries have been made anywhere. What's the size of the adjustment? So we've got a few different answers. I'll leave it for a minute while a few people are still typing, so I'll let everybody have a go at what they think, and then I'll give my 2p worth on it. Few people still typing. I'm gonna let you finish typing, and then I will give my, like I say, give my view. So what we've got is a sole trader, yeah, who is taking stock for their own use, yeah. So sole trader is likely to be cash basis unless they've decided to do something else, yeah. So only the cost needs to be removed. So that would be the £100. That's the adjustment. Yeah, we don't need to. So the cost would be removed from trading profit, the £100. If they were accruals based, so they'd opted to use accruals basis, then we would need to take out the full selling price. Yeah, but by standard, sole traders would be cash basis. We just take out the cost. Yeah. Final one then, scenario C. A leased car, 120 grams of CO2 per kilometre for a company cost £4,000. Add it back or not? And how much are we adding back if we are adding anything back? Yeah, I think most people got that. Yeah, so you're going to add back, because the lease car is over 50 grams per kilometre. Yeah, it's 120. So 15% of the lease cost are disallowable and therefore need adding back in. So 15% of £4,000, £600. Yeah, so you're going to add it back in £600. Yeah. Okay. Right, and that's your lot. So does anyone have any questions. I'm happy to answer any questions.